The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hello, this is Esther Gulius, the tax lady from EG Tax, and this is our hour to talk about taxes. And many times, well, not too many times, but a few times during the year, what we do is, because we get emails, it gives us an opportunity to answer your emails and to kind of chew up how we're thinking, because we have a lot more time in between the emails than we would with phone calls. So I'm joined in studio today with Tiffany Fabian. Hey, Tiff.
Hey there, Esther. How's it going?
Good. And Christopher Fabian.
Hello, Esther.
Hello, Christopher. So we got our emails. So we're not taking live phone-ins today. We will next week. If we get, unless we don't get through all of our emails, then next week we'll do the same thing. But right now our plan is to just answer these emails. And by the way, when you're sitting home and maybe over a dinner table, somebody's got a conversation and it goes and it drifts off to taxes and you're wondering about something, you can go to our website at egtax.com, ask the tax lady, put it in, ask your question, and I will type it back to you right away. And who knows if we won't use your question in a future show.
Yeah, I know. So, I had a client who came in and they're like, I love this Ask the Tax Lady. And he had like 3 or 4 that he printed up and he goes, and your answers were exactly the same as what they answered.
That makes
said, well, that's good.
Isn't it? That makes it nice. I mean, sometimes the questions are so complicated, you really do have to fend them off to the shows that we do like this, because it's, it's if you do this, then that happens. And, my little fingers are typing. And so so some of these are so complicated, you just have to wait. So we're going to start?
Yep. I've got Grace from Williamsville. She says, EG Tax, I just started my new business in February of 2020. I spent about $25,000 to start it up. But then COVID hit and I had to close up, and I don't think I will have the money to reopen. And can I still use the expenses to offset the money I took out of my 401k to start the bakery?
Oh. So, yes and no and yes and no and yes, right? I mean,
Yes.
So the first thing you have to look at is that she went to a pension plan to take money out to start a business, right? So the first thing that happens is, I'm assuming that she's under the age of 59 and a half. She didn't say.
Right.
And she also didn't say if she's working and whether this was really a 401k through her company or was it a 401k from another employer, right?
Right.
But first of all, the $25,000 she would have taken from her 401k is taxable and may be subject to a penalty unless she took it out of her 401k at work. And because of COVID, they said if you're under the age of 59 and a half and you took money up to $100,000 out of your 401k when you're working, then it isn't going to be subject to penalty, but it's still subject to income tax.
Right.
Right?
Yep.
That's number one. So that's the first part. The second part would be she started a small business.
Yep.
And we assume that she had a profitability intent. Now, obviously, COVID kind of shot her in the foot. So had she bought inventory, signed a lease, started advertising, all of these things are basically lost items that she can't sell and get her money out of. Let's say she paid rent and she, spent some money on rehab and then defaulted and moved out, and that was her $25,000. Then that would be expenses that she could take on her Schedule C. Right. And so she'd be able to then have a loss on the left-hand side, the income on the right-hand side, and the one they should cancel each other out.
Yeah. It's
right?
really complicated. And there's
Well, and then the other thing is you have to make sure that she had a profit motive.
Yep.
I mean, if it was, and the thing is, let's say that she bought equipment, mixers and an oven and things of that nature that she could then sell, and she never really placed them into service, then they wouldn't be deductible, right?
Yep, you have to have you have to have your shingle out, and you have to have a profit intent, and you have to be actively trying to make money.
Right. Chris, you have thoughts?
Well, yeah, but like you said, with the equipment, if she sold the equipment, then she would have to do the $47.97 on the sale of the equipment. So she may think she has a loss, but she may not really have a loss if it's all for equipment. So there is really a lot of
Right. So let's say that she spent the $25,000 on equipment and she never started her business. Then she needs to sell her equipment, and the difference between what she purchased it for and what she sells it for, that would be the only loss that she would sustain.
right.
Right.
Yep.
So, I think what was her name?
Grace.
Grace. Tell her to give us a call. Grace, call us. We want to help you.
And so we can plan. And,
Right. Because then
tease
worse comes to
everything apart.
worse, if she's under the age of 59 and a half, she wasn't working, it was her old IRA, she took the 25 out, she's got a $2,500 penalty plus taxes. Her loss maybe isn't 25 if she bought equipment and could sell it, so now she's got a substantial tax liability. So we need to talk about that.
Yep.
Definitely.
And
All right, what else we
I'm
got?
wondering, maybe she made some money, maybe she had a website, you know what I mean? I mean, there was
Right.
a
I mean,
lot.
if it was all things that you can't get your money out of, the rent, advertising, if that's what it was spent on, then she's got the full loss. But if she's got a tangible equipment that she can turn into cash, that's a horse of a different color.
Yep. We've got Craig from Buffalo. Esther, my bookkeeper did an offer and compromise for me. I think it was accepted, and this year I just filed my return for 19. It was accepted on July 10th, and I owe the IRS about $2,000. Can I set up a payment plan for this $2,000 that I owe for my 19 return?
Well, Tiff, you do offer and compromises for us.
Yep.
Don't you think that he would know if he had an offer and compromise accepted?
Yep. But I know one of my clients, also he's busy working, and he gives this stuff to his bookkeeping team, and he sort of trusts them. So stranger things have occurred. But if he does have an offer and compromise and it was accepted, the law says for the next 5 years you have to be current. So whatever he owes by the filing deadline, it has to be paid.
So he just messed up his offer and compromise.
Right. He can't set up any more payment plans. It has to be paid by the filing due date.
And if he didn't pay it, there goes the offer, and all that whole
and
debt
he
comes
wasted
back.
all of his time and money.
Yep.
Right.
Because to present an offer, you have to send money in with the offer to have it be accepted.
Yep. And there's an application fee.
So that's what's really important is if people that have outstanding liabilities for whatever reason, if it was for a horrible situation in their life and they had to take money out of their pension plan they didn't know about or whatever, those people have to change the way they were doing things in the future in order to move forward when you have an offer and compromise. Now, an offer and compromise is when you basically say to the IRS, hey, for whatever reason, here's why I owe you all this money. I can't pay you. I don't have any assets to pay you. My job prospects are not substantial enough for me to come up with the money. I'm asking that I can come up with this money here. I got $5,000 I can come up with. My mother's going to loan me the money. Will you reduce my liability down to this offer? And they say yes. That's an offer and compromise. And so, but for the next 5 years, you have to say, I'm a good boy, I'm a good girl. For the next 5 years, I'm going to make sure I timely pay my taxes. And that's just really imperative.
Yep.
Yep.
Absolutely.
It's like filing bankruptcy with the IRS.
Yep. It's doubt to collectability. So if the IRS thinks, oh, you have equity in your house, well, then go get a home equity. Or if you make a considerable amount of money, then they're not going to accept it. And I
Okay,
think,
what else we got?
We're going to go to a break, I think.
Yes.
Are we going to go to a break? I'm Esther Gillius, the tax lady from EG Tax. We're going to see you on the other side. We'll see you in a second. Hi, this is Esther Gullius, the Tax Lady. Thanks for listening to Ask the Tax Lady. We're this week we're doing something a little extra different. We are answering your emails, and because sometimes it's just so complicated, the answers that we're unable to type a volume of things to you when we're answering back. So we kind of go over it several times a year. So this is our email Saturday. So we're not going to be taking your phone calls. We will hopefully next week be back doing our regular question and answer period. But this week we're answering your emails. And again, if during the year you have any questions or you're at a party and people are talking taxes, just say, gee, I'm going to ask the tax lady. Go on our website at egtax.com, type in your question, and most of the time I answer them right away, so we want to help. All right, and we got Tiffany Fabian, Christopher Fabian. They're going to be reading the questions. What do we have next?
Mike from Buffalo. Tax lady. I just couldn't get my stuff together by the 15th of July. Now what? Do I wait until next year?
No. I mean, you can. If you have a refund, you actually have 3 years to file and not lose that refund. But with all the things coming down the pike with stimulus and PPP and all that stuff, I would suggest, because you never know what they're going to come up with because of this coronavirus stuff, that's all based upon your tax filing. So you don't want to have unfiled tax returns. You might miss out on something. So I don't think you should wait. Get it done as soon as you can. Plus, you don't know if you owe money.
Right.
Without filing the return, you don't know your situation. If you owe money, then they're going to penalize you for filing late, which is a big penalty, 5% a month until you get to 25%.
Yep.
So you don't know till you do it. So I would suggest you get it done. You guys have any other thoughts?
Yeah, absolutely. Get it done. So like Esther said, I was just going to reiterate, the first month it's 5% of what you owe. The second month it's 10, the third it's 15, fourth it's 20 up, and then the final month it's 25%. So get it filed.
And it's 25% going forward too. I mean, it's not just, it's a lot of money.
It's a lot of money.
Plus you got the state.
The state, that's what I was thinking.
And I know, dealing with some clients already, the partnership and corporation deadline was not extended. People are, I had some people who filed a partnership return late and they're going, oh, it's fine, it was extended. And then they got the bill for $200 a month per partner.
Jeez.
So, and I called the IRS for one of them saying, hey, look, can you get this way? And they're like, well, you got to write us in a letter and you got to have a good reason. And so it's not they're not just automatically waiving penalties. So get the return done and get it in as soon as you can.
Right. And again, it's like anything. We know from the COVID situation here that an ounce of prevention is worth a pound of cure. And so everybody's masking up and washing hands and putting gloves on, because the result is that if you don't, you can suffer a problem. Well, it's the same way with taxes. If you don't pre-plan and you don't know what's going on, it can hurt.
Yeah.
Just like the darn COVID thing.
Yep.
So, okay, let's go. What else we got here?
Mary from Boston says, tax lady, our 17-year-old daughter gave birth to a beautiful baby boy in January. We would like her to finish her education and live with us for the next few years. Naturally, we're in love with this baby. How does this affect our taxes?
And again, congratulate. There's nothing like being a grandparent, and those of you who are grandparents know how wonderful that is. It's a little shocking when your 17-year-old is giving birth, but in that end, it's all worth it, right? I mean, it really is. So here's the thing. It looks like your daughter is not working, and obviously the baby's not working. So what does this mean to Grandma and Grandpa, you guys? That
they will be claiming the daughter and the baby. And there's a $2,000 child tax credit for the baby, which is really exciting.
And $500 for their daughter.
Yep.
So that saves on $2,500. Plus,
she's going to go to college.
It sounds like their daughter's going to go to college.
Yep.
Which means what?
Potentially another $2,500 credit
on the federal and like $400 on the state.
Yes.
Right. So Grandma and Grandpa could benefit by like $5,000 in tax savings, $5,000 or $6,000 in tax savings. So that's really a wonderful thing. So now, let's say that their daughter this year goes back to college in 2020, but in 2021 she starts working. How does that change Grandma and Grandpa's situation?
Well, the mom has the right of refusal, so it all goes back to mom. If mom says that you can claim the child now, they can't be claimed if she's working and she's not in college. But if she's still in college, then the daughter has her first right of refusal.
Right, and what you want to look at is the $2,000 child tax credit, or for Grandma and Grandpa, or the earned income credit for the daughter better. So you may not want to claim them if the daughter is working, because it could be better for everybody to have the daughter claim the baby boy and get the earned income credit.
Right. So let's talk about the earned income credit. The earned income credit is for people that are earning money. So if the daughter, we got Grandma and Grandpa and the baby, and the daughter and the baby, right? So if the daughter goes to work and makes money, and the daughter lives with a qualified individual, which would be her child, then the daughter has the right to claim the baby first. Now, the daughter, if she's working, would also qualify for an earned income credit, which means they're going to give the daughter money because she has this baby that's living with her. And if if she has wages of like $8,000, $9,000, this earned income credit could be almost $3,000. Plus, the daughter would get part of that $2,000 as well. Right?
And she'll be eligible for the stimulus, any stimulus possibly, too, unless she's claimed.
Right. But I think that ship has sailed. But I mean, I'm talking in the future. Let's hope to God there's no stimulus in 2021. So the daughter could get the earned income credit, part of the refundable child tax credit, and the education credit.
And the New York State earned income credit.
And the New York State earned income credit. And if the baby's in daycare, she would get a refundable daycare credit on New York State.
Right.
So
you have to weigh
this year, it doesn't sound like the daughter's going to work at all. But next year, if the daughter goes back to work while she's going to college, then Grandma and Grandpa wouldn't claim her, wouldn't claim the grandbaby, and everything would go to the mother, maybe. But the best thing for the family to do is to look at how much money is going to get lost by Grandma and Grandpa, and how much the daughter will make from an earned income credit. But again, she needs wages.
Right.
Right?
Yep.
Okay.
So
let's stay with the theme of college. It says, EG Tax, I received a letter from New York State, and they are disallowing my college credit, I guess, or questioning it for my daughter. Should I just pay the money for her college cost a lot? And this really seems unfair. Scott from Hamburg.
Okay. So why don't we talk about that? On the federal and the state, for the first 4 years of higher education, there are these wonderful credits out there to help offset the expense of college. What happens after the first 4 years?
Well, if they go to graduate school, New York State, well, are we talking federal or state? Because
I'm talking both.
Okay. Federal, first 4 years, you get the AOTC. After that, you get lifetime learning. So it goes from a $2,500 credit of that, $1,000 being refundable, to a $2,000 credit, up to a $2,000 credit for the lifetime learning credit, none being refundable, meaning if your tax is only $800, you're only going to get a credit of $800, even though if you were entitled to the full $2,000.
Now, I think everybody should be really careful. There's some of my clients that their child, half the year they were finishing their bachelor's and there was cost involved. And then the other part of the year they were working on their graduate degree. So really what you need is a billing statement so you can tease off what was for undergraduate and what was for graduate. And you could provide that for proof to New York State.
Right, but on the federal, you can only take it 4 years.
The AOTC.
AOTC. On the state, something's different. How does that work?
Yeah, the state, you're entitled to all undergraduate education as a credit. So whether you go for a 4-year degree and then you go for another 4-year degree and they're both undergrad, you continue to get that credit on New York State. As soon as you switch to graduate school where you're going for your master's and beyond, New York State says, no, you're not entitled to that credit. So like Tiff just said, if you're in that in-between year where half is undergrad, half is graduate, then you do need the itemized billing statement to send to New York. Do not just pay them.
Hopefully this is what this taxpayer is wrestling with, is that they got the 1098-T form said that it was for graduate school, but maybe it was only for half a year. So they would be entitled to the undergraduate portion on the state of New York.
Yeah, and don't forget there's now the adjustment to income for tuition and fees. So if you're somebody who maybe is a high income earner on the federal, you might want to revisit, and you can actually amend your 2018 return because it was retroactive for the tuition and fees for the federal if you were disallowed it because your income was too high on the federal.
Right, but specifically on this particular person, the guy that's got this bill from New York State,
Yep,
don't just pay it. You know, give us a call. We don't charge anything to assist you with letters from the federal and state, and we will interpret it for you, show you what you need to get, and help you to put together the response.
Right.
Okay?
Yep.
Yes.
Yep. And then
If you don't forget, if you need us during the week, you can call us at 632-7886. Go online to egtax.com. Ask the tax lady, like Esther said. She loves it. Frank is signaling us it's time for the news.
Okay, we're going to take a short break. We'll be back on the other side with your emails. I'm Esther Gullius, the tax lady. Hi, I'm Esther Gullius, the tax lady from EG Tax. We are answering your emails today, and it gives us a great opportunity to really kind of dig in there and tell you how we're thinking. You can see when you listen to what our answers here that, wow, there's a lot to it because taxes are very complicated, and it just really isn't black and white. Sometimes you can take something that you think is black and then you put a little other seasoning in it and it turns to white. And so all of these kind of things are really important, and you're going to see how many of these things can't just be answered by a quick yes and no. That requires a lot of thought, because what you do can determine your tax liability for sure. So I'm joined in studio with Tiff Fabian, Christopher Fabian. We're answering emails, and we got another one here.
Yep. Larry says, EG Tax, my business didn't get any PPP money because we were too late to apply. I have 10 employees, a small service business. We are getting our head above water now, but it's tough. It's been really tough. If I don't get any of the new PPP money, is there something for me right now? Larry?
Yep, there is. There's the
Loans.
employee retention credit.
There's the employee. Yep.
Pardon me?
Yes.
So the employee retention credit is a credit that you get right now for the first $10,000 of wages that you pay to employees if you haven't gotten PPP money, with a maximum credit of $5,000 per employee. So in his situation, he could have a $50,000 credit coming. But again, this goes through his payroll.
Right.
And so you got to make sure that, and I'm not sure, have you guys seen that? Do payroll companies know about this?
Yes, they do. Yep.
All right, so they know what to do. So hopefully Larry's not doing his own payroll to save money, because in the net end, he could be costing himself $50,000 in credits. So it's called the employee retention credit. And so you would still have time to affect a positive thing on your business this year if you haven't gotten PPP
Now,
money.
if he would have gotten PPP, he wouldn't have qualified.
Then he wouldn't qualify.
And there's also the EIDL loan he could possibly get,
That's true.
the Economic Impact Disaster Loan. So he could apply. Now, that's different than the PPP, because the PPP can turn to a grant.
Right,
And
but here's the thing. I mean, on the EIDL loan, which it might be a grant as well. That doesn't preclude you from getting this employee retention
Right.
credit. So the important thing, if you're an employer listening and you haven't gotten any help from the federal government and you're just treading water hoping that you can make it till this whole thing is over, you can give us a call. We'll be very happy to help you, but there are big credits out there, which means that they are going to give you money if you have employees. So give EG Tax a call at 632-7886, or you can email us at egtax.com, and we want to help you. I tell you, I mean, I want the economy to thrive again. That's
Amen.
Well, we'll
That's
just
my
look
hope.
at Kodak, and so how they're
I
dumping.
know Kodak says they're going to go into the medicine business.
Yeah,
Good for
and I
them.
think they got a grant from the government, and so I think our current administration is really trying to tackle some of the fact that all of our products, medical related, is produced over in China. You know.
And they don't especially like us. So,
Right.
Okay, we got another question?
Mitch, EG Tax. During the initial stock crisis, I dumped all of my stock near the bottom. I have losses of over $100,000. So can I just take the loss on my 2020 return? I don't think I can handle the roller coaster any longer. That's Mitch.
Okay, well, that's a sad question.
Yeah.
Yeah. Well,
I would see if there's any gainers that he still has.
Well, first of all, is this inside his IRA, his 401k, or is it his outside investment? Because it's totally different.
That's true. That's true. Why don't you explain the difference, Chris?
Yep. Now, if this was inside his IRAs or 401k, that loss isn't deductible. So if he thinks, oh, I sold all that stock, took that money out of his IRA or 401k, he's in for a big surprise, because that's all going to, whatever he takes out is going to be taxable, and depending on his age, could be subject to a 10% penalty. So that mean, if hopefully that's not what it is, because that
It didn't. I mean, you can't tell in an email, and that's many times why
Yep.
I like to do these programs, because you don't want to read something into the question. So it looked to me like it wasn't out of an IRA.
Right,
but-
I know, but I just wanted to say, because how many of our clients say,
You're
"Oh, I
right.
lost
You're
all my
absolutely right.
money this year. What am I supposed to do?"
You're
And
right.
it's inside.
And
of,
really, just because he sold it doesn't mean he took the money. If it wasn't an IRA, he
Right.
could have just put it in a CD or
yep,
something.
yep.
A CD IRA.
But
but
now,
if go on.
now, if it was in a regular investment account, so then if he sold the stock, then he has that $100,000 loss. You put that on the tax return, but unfortunately, that $100,000, you get to use $3,000 a year. till
Not
it's-
100.
Not the 100,000.
Well, that's why I was saying if he had any money left, if it was an independent account, he could sell some, stocks that were gainers to sop up and utilize some of that loss right
But
up
that's
front.
the only way. So kind of many aspects of taxation depends upon the nature of the income. So like wages and pensions and interest income, that's all taxed as regular income, right? But capital gains and qualified dividends are taxed as capital gains distributions. So they have a reduced tax liability. Some people don't pay any taxes on the sale of capital assets, but there's also restrictions upon losses. And the restriction on the loss is you can only claim the losses against other capital gains, dollar for dollar, or else you have to carry it forward as at $3,000 a year until they have other capital gains to offset it against. So if Larry, is it Larry?
Mitch.
Mitch, I'm sorry. So if Mitch had $100,000 in losses and he had no other capital assets to sell it to offset it against, then Mitch is going to be limited to $3,000 a year for 33 years. Unless he has some gainers to offset it against, like Tiffany said. Now, if he has no other capital gains, then poor Mitch is just going to be 33 years of misery. Now, at some point in time, let's say he had a rental property and he sold that. He'd be able to offset that loss against the gain on the rental property, or if he had any other capital assets like land that he was selling. But unfortunately, if he has no other capital assets, he's going to be limited to that long period of recovery of his loss. So
Yep.
not happy. I would suggest he look at some ways of looking back into, maybe he wants to go back in the market. I know he doesn't like the roller coaster ride, but I would suggest he go talk to a financial planner, because this is a big thing.
Yes. Yes.
I mean, like, for instance, if he takes money out of his pension plan, he still can't use that loss against that income. I mean, capital gains and losses are taxed completely differently than other sources of income.
Yep. Yep. You may want to go look at flipping a house,
Right.
a one-time flip,
There you
because
go.
he could
because
use.
the house is a capital asset.
Yep. So.
And the real estate market's hot, so he just might want to change the way of investing.
Yep.
Okay, we got anything else
I've
here?
got Julie. Esther, my new husband wants to file joint, but I usually get a big refund. He usually owes because they say he'll take his refund to pay his back taxes. If we file joint, is there a refund that I will get to take my portion of the refund? I think we should file separate.
Okay, so
Julia.
once you get married, you're married. You're either married filing a joint return or married filing a separate return. So you don't have the option of pretending like you're single or head of the household. That's gone by the wayside. There is a caveat in the event that you don't live together with children, but we won't discuss that. But so you're married joint or married separate. If you're married separate, basically it's half of the deductions that you would have gotten if you're married filing a joint return, with some restrictions, because there are things about filing separately that they don't like. So they won't let you take the child tax credit. They won't let you do
The student loan.
student loan interest. If one itemizes, the other has to itemize, and so forth. So
college credits.
but you can still file jointly, and if your spouse has an outstanding liability, your share of the refund won't be affected by filing a certain form, which would be called.
An injured spouse, and
Right.
on the state it's called a non-obligated spouse.
And so if you file that form with your tax return, they just look at his part of the return, take his part of the refund to pay his liability, but your part that you would have gotten if you were filing separately would still be there, plus allowing you to take all those credits and restrictions that they would have put on you if you were filing separately.
Right. And then, going back to an earlier text, depending, how much does he owe? Is there something that can be done? Is he on a payment plan? Is there, could you do an offer and compromise if it's a super big dollar amount? There's different options to look at as well.
And then many times people don't want to pay their outstanding liabilities, and so they walk through life with this big albatross hanging around their neck. And I will tell you, there's nothing like cleaning up your finances so that you can take advantage of all these wonderful things that are available to you when you have great credit.
Yeah,
That's right.
I mean, especially when you come into a marital situation and the other spouse maybe had this outstanding child support, outstanding student loans, and you think that you can't get over them. Student loans are especially hard to get over, because you can't even go into bankruptcy to get rid of student loans.
Yep.
Under the CARES Act.
But planning is so important, and I think that's a kind of a theme that you've heard all day long here. Planning is so important, because if there's a way to pay it off, even though new bride, it was not your liability, the two of you will benefit so much more in your future together, long term, if you can get rid of whatever debt that he has.
Yep. It may be worth it to have the refund taken just to get rid of his debt.
Absolutely.
I remember I had somebody with student loans and the refund was seized, and they're like, oh, this is her fault. This is her fault. I want my money. And it was enough to cover the debt. But he wanted that injured spouse, so we filed the injured spouse, and his wife
And
still
the
got
debt continued.
and to grow interest.
Right.
So You know?
Well, when I'm counseling with people about offers and compromises, they might not qualify, but we talk about getting a loan against their pension or even getting a loan from PenFed or a home equity or borrowing money from family because, like Chris just said, the interest and penalties are atrocious from the IRS.
And, you think about this. There's all these other things. When you owe the IRS and state of New York money, it affects your credit score. So if you have bad credit, it affects everything. The insurance that you're paying for your car, potentially new jobs, the interest rate that if you ever want to get a house, the interest rate that you're going to pay on a mortgage, credit cards charge you more. So it's not just that one debt. It's everything else moving forward. And I think sitting down and making a plan is a really great thing to do. And like you were saying, Tiff, about borrowing money against your 401k plan at work, then you're paying yourself back.
That's right. Yep.
And that's a great plan. So sometimes, it hurts, but long range, it's like really cutting yourself 1,000 times if you don't clean up that debt.
Yep.
Yep.
Okay, what else we got?
Well, we got
time for a break?
Time for a break.
All right, I'm Esther Golias, the tax lady from EG Tax. We'll see you on the other side. Hey, everybody. I'm Esther Golias, the tax lady from EG Tax. Today we're answering your emails because they require so much more than just little text back and forth because they're so complicated the way that you can answer them. So today we're doing emails. We're not taking phone calls. If you need us during the week, though, you can call us at 632-7886. You can go to our website at egtax.com, click on Ask the Tax Lady, and also wanted to remind you, our tax school is coming up.
Yep.
So if this is interesting to you, our tax school is remarkable. You will learn so much. We'll help you in your own finances, and the opportunity then is we hire for next tax season, we hire the very most qualified interns, and we start a 4-year program with you. So it's a
almost
great
like
way to earn extra money.
paid
It's a
job
great way to
training.
learn about your finances and your tax situation, and you become a more interesting person at a party.
Yep.
Right?
That's right.
Um,
Come tax time.
And tax
but
time, everybody
taxes
talks
are
to you.
all year
right, we
long.
got other questions.
Esther and gang, greetings. My father passed away in 19, and in 2019, prior to his passing, we sold $50,000, and the 1099 from the bank was in my father's name and not the estate's. Is that okay? Someone told me that it should have been in the estate's names, tax ID number or something like that. Could you please advise? Beth from Cheektowaga.
It's interesting how often this happens, that they don't have the right EIN number. So have you guys ran across a lot of this? What did you do with that?
I thought Debbie did recently at our office, right, Chris?
Yep, and I had somebody as well. And, we'd had the bank reissue the 1099.
Did they?
They're trying to get it done.
It's so interesting because when you're a living human being, then your social security number is your steering factor. That's who's going to get taxed, is you as an individual. Once you pass away, then the assets that you have and the income you receive after your death goes to your estate.
Right.
And it's called a fiduciary return. So they would be putting the income and the sale of those of the stock after the death of the person in the estate of. So I would suggest you go back and try to get him to correct it. And for those of you that are executors or executrixes of estates, once the person has passed away, you have to make sure that you let the banking and the financial institutions you deal with know that they have passed away, and give them that employer ID number that the federal government will send you. They will send you a number right away.
Yep.
And that is the new number for the estate of.
And what would happen, Chris, if they don't get it corrected?
Well, if this one was strictly in Beth's name, that 50,000 would have to go on her return, and depending on her income bracket and everything else, she's going to pay tax on the whole thing, where maybe her siblings were at a different level where if it went to the estate could issue the K-1, so you got to look at the
And
whole
divvy it up.
And
divvy
again,
it up.
there would be a stepped-up basis, would there not?
For interest, no,
Oh, it was interest.
Yeah.
Interest, not
not a house.
If it was the sale of stock,
Yeah.
or sale of other capital assets, like we were talking about at the beginning of the show, capital assets are handled different than interest and wages. So Chris is exactly right. If it's interest and it was in her Social Security number rather than going to the estate of, then she's going to end up getting stuck with it.
Right.
Instead of divvying
And
it up.
depending on her income and their age, we've seen it where it could impact their Medicare, how much they pay for Medicare.
So
It could
okay, so here's a thought. If in fact this wasn't her interest, it should have gone to the estate of. Why can't she do a nominee distribution back to the estate
She could.
and just type the W-2 back
The
to the estate?
1099 back
I mean,
to the-
1099
yeah.
back to the estate,
Yeah.
right? So again, it all depends on how the whole thing was handled, and so suggest you come on in so we can talk to you.
Yep.
Right?
Yep. Really good point. And
All right.
we'll help you call the bank and make all those phone calls.
Right. All right. I'm Esther Gilius, the tax lady from EG Tax. We're answering your emails. If you have questions, you can go to our website at egtax.com, ask the tax lady, and we will answer them as best we can. Many times we hold the more complicated ones till we do these shows a couple times a year. And we got another one here, right?
Tax lady, this is Corky. I was working in Florida until the pandemic. I wasn't getting unemployment down there because I moved back to Buffalo to live with my parents. Since I'm 35, I'm embarrassed to admit that I'm living with my folks and I'm making no money. What happens now? I didn't get the stimulus because I moved.
Okay.
Corky.
So, regardless of a person's age, if they don't have income over $4,400 or taxable income over
Right.
$4,400, they still potentially can be the dependent of somebody else, right?
That's right.
So it sounds like Corky had no money, and he's living with mom and dad, so he would then become mom and dad's dependent.
That's right. And
Right?
so because of that, he was disallowed from the stimulus money, and mom and dad didn't get any stimulus money for him because he was older than 17. And
Right, and this would be 2020 that he moved back to Buffalo, right?
Yep.
So in 2020, he would be mom and dad's dependent, and they would then get $500 for him. But if he wasn't, and when I haven't seen the forms yet, but I understand that there is a stimulus section in there for people that didn't get the stimulus money, he might be better off just filing his tax return in 2020 and claiming that stimulus credit because they're going to give him $1,200.
Right. But, did he work in 19? He should file his return for 19 to get the
Yeah,
stimulus
because-
check.
Well, that's true.
And then with the unemployment issue, Florida should still be giving him unemployment because that's where his work was, unless now he's disabled or something like that where he can't work. Then they could say, well, that's why you're not getting unemployment. But if he moved up here to get a job and to try, unemployment should still be issued through
So
Florida.
the important thing is to not just, as a matter of fact, many people that I've talked to are having a hard time getting their unemployment, no matter what state they're in.
Right.
I happen to know because I have a house in Florida, that in Florida it was horrible to get unemployment. So this guy has to be diligent and contact the state Department of Labor in Florida and say, hey, I'm entitled to, he'd be entitled to the pandemic,
Yep.
the $600 plus whatever Florida would give him. But laying down and doing nothing is the worst thing you can do. And that's part of what we also help people with, right?
Right.
With unemployment, making phone calls, going on their website. Yep.
Right. I mean, we will be very happy to help you. So if you want to come in, so if you haven't gotten any money in 2020, you can be mom and dad's dependent. If you get over $4,400 because maybe they're going to pay you all this money back, then you can't. But you definitely want to, like Chris says, file your 2019 return if you haven't, so that you can get your stimulus. And if you still don't get it by the time you're doing your 2020 return, you can get the stimulus on your 2020 tax return. And if you're out there and you just haven't been, I know a close friend of mine started getting his unemployment and then they stopped. And this is in New York State. And he contacts them all the time and they say, we're going to get to it, but they still haven't. So they seem to send out lumps of money to people. But the thing is, don't give up, be diligent, and you can,
And let's face
you're not working, you got nothing else to do, right?
And let's face it, 2020 is halfway over. So this person
More than halfway over.
very well is going to probably get a job and be over that personal exemption of $4,400, I would hope. So probably mom and dad won't be able to claim them. I would hope
But
that
right
they're
now,
going to get a
based
job.
upon what we know.
Right.
Right?
Yep.
But don't give up on that unemployment. My gosh, if you get the $600 pandemic portion that you're entitled to, that's well over the $4,400. Can you imagine getting $8,000 or $9,000 or $10,000?
In one lump sum?
Right.
Wow.
But keep it up, and if you need help, call us at 632-7886. Right?
Yep. And I think we got time for one fast one.
I've
All
got
right,
a fast one. Esther, my divorce was finalized in 19. I have to pay my ex-wife alimony of $25,000 a year. Can I deduct that on my tax return?
Only on New York State.
Yes. Yeah, because that
was fast.
under the tax reform, if your divorce was finalized in 2019, no longer can you deduct that alimony, and no longer does the person who receive it have to declare it as income. So Chris always raises a really good point. Those wives or husbands who get alimony, they don't have to declare it as income. So that opens up the field, if they have children, to get earned income credit. So they might want to go get a little job, because before, so many people who had to pay alimony were earned income credit was taken off the table. So now it's something that's real and alive and a potentiality for them.
And that's exactly right. So if mom had gotten divorced prior to 2019, that alimony would have been taxable. 2019 going forward, alimony is tax-free to the recipient and not deductible to the payer, except on New York State. It's just the opposite. On New York State, it is taxable to the recipient and deductible to the payer until they change that law. So she would then, if she has children in her home, if she works where she wouldn't have qualified before, she would qualify. So it's for the earned income credit. So it's very important. A great point, right?
Yeah.
Yep.
All right. I'm Esther Golias, the tax lady from EG Tax. We are here all the time to help you. We're doing tax returns every day, Monday through Friday. If you need us on the weekend or on Saturdays, in the evenings or on Saturdays, we'll be very happy to meet with you. Don't forget, our tax school is coming up. And if you need us during the week, you can always get us at 632-7886. You can visit us online at egtax.com. Until next week, I'm Esther Golias with Christopher Fabian, Tiffany Fabian, and me. Have a great week.